So today's cardinal lesson, we're talking about taxes, and we really are borrowing from one of the groups that we're at, Ed Slott. We're taking a questionnaire that he posed these 8 questions. They're really for you, the listener and the viewer, to ask yourself these 8 questions. So I want to turn it over back to Drew.
Thanks, Hans. Tom, can you tell us why are we doing this video today?
Yeah, I mean, we're doing this video because no one likes paying taxes. They don't like paying them now. They don't like paying them later. And most of your retirement savings are in accounts that are going to be taxed. You're going to have to pay tax on money that's in an IRA, that's in a 401k. And so these 8 questions we're going to go through that we got from Ed Slott really help you think about how to prepare for retirement. The earlier you ask these questions in your sort of the retirement cycle, the better you can prepare for that. Because ultimately, with all planning, I like starting with the end in mind. I like knowing where we're trying to get to, and we work backwards to make decisions now to help us get to that end goal. So these 8 questions help prompt that. Again, if you have a child that's early in their career, pose these to them, right? Because it helps them make decisions now in preparation for that. If you're closer to retirement, still ask the questions. You have less time to make adjustments, but we certainly can. And so let me bring up the show notes. You can find these at the link below our video. They're also on our website at cardinalguide.com. Again, we have this chart that's this retirement tax checklist. Again, this is we got from Ed Slott. Hans and I are part of this Ed Slott group. We're Master Elite Advisors. We go twice a year. Ed Slott is a CPA. He's known as the America's IRA Expert. And we get a lot of ideas, a lot of planning around that. And it's really around how to handle IRAs and 401ks. I'll let Hans talk a little bit more about that. But we have the checklist. It's the 8 questions that we're going to pose on the board. And then we have this chart that's in a lot of our show notes. It's the different tax brackets. There's a lot of information on here. Print this out. Keep it. I have this on my desk I use every day. And then the IRMAA, we'll get to that a little bit. This is the increased cost for Medicare. So I'll turn it back to Drew, and we're going to go sort of one by one and go through these 8 questions that's on this tax checklist.
Sure. So Hans, before we get to the first question, do you have any additional thoughts just surrounding Ed Slott and your experience with that over the years?
Well, I went to Ed Slott in 2012 for the first time. And the way I got into Ed Slott's class was it was $2,000 to attend. And I knew about him, but the $2,000 plus the expenses to travel a long distance. And I'm thinking, what's he going to teach me? I'm a CFP. I got all this experience. So one of my clients or potential clients becoming a client gave me Ed Slott's book. He says, here, read this. And I took it, read it, and then I went back to that client and did some more planning. And I used the money that I made out of that planning. This is when I first opened my business. So I was a little short on funds to be spending on going to some class somewhere. But anyhow, I used that money. I went there. And when I sat in the class listening, I learned, I said, man, this is the best money I ever spent because I'm hearing a whole different perspective. And so all my career and all my life personally, I've thought, boy, I'm getting away with something here. As to the government is contributing to my IRA. I mean, it's just through the tax savings. And, so that I'm putting in $20,000 into my 401k, and I'm really only putting in $12,000 because the government's putting in $8,000 of it. And, this is just going on and on and on and on and on. And so I got this big, I'm not paying any tax on the growth. I'm just thinking this is wonderful. And what Ed Slott got me to think about is, okay, so now when you start to use this IRA money in retirement, what's going to happen? What kind of taxes are you going to owe? How are you going to do this? How are you going to meet required minimum distributions? And then you take Ed Slott's training and planning to the hilt. We're going to minimize all that. And we just have this ballooning, growing, large, what he refers to as a tax bomb. And then we end up leaving that to our kids and yada, 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 yada. So Ed Slott has really taught me, and he's taught Tom and me, because I brought Tom in there about 5, 6, 7 years ago. And so the two of us are sitting in there and becoming experts like Ed Slott is on 401k IRA planning, of trying to set all this stuff up and use the law to our benefit is essentially what we use the law and the regulation to our benefit and to our client's benefit to pay less taxes in the end, or to be left with more money to leave to our spouse to enjoy in retirement, yada, 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 yada. So anyhow, that's kind of a big plug for Ed Slott, and we've learned a lot from him, and we're going to continue going to the meetings as long as I'm going there. And we got this questionnaire, and as soon as I looked at this thing in the meeting, I said, we're going to do a whole video on it because these are 8 great questions. So I'll turn it back to you, Drew, and let's start going through the questions.
Wonderful. First one, are you exposed to higher future tax rates?
I mean, my answer to that is probably. I mean, I can't say for sure, but I mean, we have a lot of clients doing Roth conversions that are married, filing jointly, and they're converting to the top of the 24% tax bracket. So they're voluntarily paying a bunch of taxes through Roth conversions to preserve the 24% tax rate. Now, if you're single, that's just over 200,000. If you're married filing jointly, it's over 400,000. So you have somebody that's at an income level of, let's say they have 150,000 of income, so they can do a $250,000 Roth conversion, which is a lot of money in 1 year, and not pay any more than 24% federal tax. And so that's a long-winded answer to tax rates from my perspective are low. 24% is low. And even if you get into the 32 and the 35%, historically, those rates are low. And some people have to go to those rates to do Roth conversions. So the question is, are you exposed to future higher tax rates? I think that taxes are going to have to be higher 10 years from now. I just do, because I think the way the whole economics of the government works, I don't think we can maintain these 24%. So the answer to the matter, I'm going to change it from probably. My answer to that is yes, you are exposed to future higher tax rates.
And looking at the first bullet point under that, about the concentration in tax deferred accounts, is there a particular percentage that we would view as maybe a caution or a red flag when we're planning with our clients?
Well, I mean, like if I go personally, I've converted all of my IRA to Roth. Okay. And I've done that. I'm 68, and I've done that before 68. And some would argue that I paid too much in taxes to do that, that I'd have more in there. So we're going to treat me as the extreme. Now, I intend to start accumulating going forward some IRA money or 401k money now in the tax deferred area, because I want to take advantage of QCDs once I'm 70 and a half, which is like 3 years away. So I want to do my charitable giving out of my IRA, which means I'm never going to pay taxes on that money. Now, when we get to the general public, so the answer to that really is there is no steadfast percentage. A lot of it is going to be on preference, is that most clients that are coming across the table from us, that are sitting across the table from us, they're not going to convert all of their Roth money. They maybe have too much. I mean, it just, like the gentleman I was talking to yesterday, he's got 1.7 million, no Roth, all IRA. He's not spending any of it. He's 69 years old. His wife is 63. She's got like 550. And they don't really foresee needing any of it between their pensions and Social Security checks and their spending levels. And so, but he's very interested in Roth conversions because RMDs terrify him at 73, because he's already calculated. He's a smart guy, and he knows he's going to have money thrown at him. But there's no way I'm going to get him to 70, 80% or 60%. I think that like half of his money before RMDs, if we could get him on a schedule so that when he reaches 73, which is 4 years from now, this 1.7 million has perhaps grown to 2 million, 2.2, And if we could have $1 million of it converted before RMDs, that's going to substantially reduce his RMD. And then we could continue doing that after that. So the answer is there's no steadfast number, but I'm going to first try to get people convinced to do some of it if it's appropriate. And then we're going to get into how many years is it going to take you to get to a level that you're comfortable with.
And just to your earlier point, with the current historically low tax rates, that second bullet under the first question, unused lower tax brackets, they are gone forever. It's just a really prime window of opportunity for a lot of people to consider this as a part of their plan. Again, not for everyone, but I think it's worth having the conversation, and we certainly do that all the time.
Yeah.
I'm gonna jump in on that point because I have a client I'm dealing with right now that we were sitting down. He brought his tax return from 2025. We're looking at it. He paid like $50 in taxes, which is like, man, that feels great. These are federal taxes. It's like, man, you paid so little in taxes. You got to keep everything. I said, I'm sorry. He said, why are you sorry? Because this is good. It's like, I mean, it's good for now. What happens in a couple of years when you turn 73? Those RMDs alone are going to push you into the 22% tax bracket. And you're going to look back and said, I could have gotten money out at 10%. I could have gotten money out at 12%. And now my top rate is 22% in the future. And so, it's not always the 24%. It depends on the size of your IRA. It depends on your other income. Depends on if you're single or married. So again, it's all very dependent upon your situation. But certainly, if you have like zero income, or you could fill up to 10% or 12%. I mean, if we can get money out, I mean, you probably deferred that. You probably got a tax deduction, probably in the 20% range when you were working and contributing to these accounts. If we can get it out at 10 or 12%, we absolutely should be doing that. And so certainly you don't want to lose those brackets. And then if your accounts are very large from an IRA standpoint, that starts where you start looking at the 22, 24%, as opposed to the future 32, 35%, or they might raise rates, right? To Hans's point, rates could be higher from now. I mean, it takes Congress to do that, but from a debt standpoint, as we're still running a deficit where the debt is growing. They're going to have to pay that back at some point. I don't think they're going to be able to cut spending enough to balance the budget. So I think they're going to have to raise revenues. How do you raise revenues? You increase taxes. So it's just a math problem. I think at some point they're going to have to raise rates. And so the question is, are you exposed to higher future tax rates? I'm back to Hans's point, probably. Again, depending on your account size, depending on where your money's at. If you have all Roth money, then the answer is no. If it's all in a Roth like Hans is, you're not exposed to future higher tax rates because it doesn't matter. It's all tax-free. So again, that's a pretty extreme example. Everyone's going to be somewhere in the middle here, and that's why the planning is important to approach this from.
Yeah. And I think just leading us to the second question, which is, are you using the years before RMDs or required minimum distributions? You touched on something, Tom, where a lot of it depends on the gross amount you've got in these tax-deferred accounts. Converting $50,000, $60,000, that's a lot of money. But for someone who has maybe 500,000 versus 5 million in tax-deferred accounts, it's not nearly as meaningful of an impact for the person who's got 5 million. So there's, again, just a lot of planning involved. We do a lot of the forward thinking for you guys, and in hopes of really informing you so you feel confident in a decision. But don't let the gross numbers scare you. There's a way to go about this that can really make it most efficient for your family and the life of the money. All right, so let's move on to the next question here. Again, are you using the years before required minimum distributions?
Yeah, I mean, this is sort of a sweet spot that you can take advantage of, right? While you're still working, your income is probably high, right? You're later in your career, you're probably in your peak earning years, right at the end of your career. And it might not make sense to do conversions while you're still working. Sometimes it does, but let's just assume that we're not converting money while you're still working. You retire, I'll just assume 65, and let's say your RMD start at 75. Depending on when your age, it could be 73. But for my example, let's assume your RMDs are 75. We now have this window of time where income is lower because we're no longer working. RMDs haven't started yet because those don't start till 75. And you maybe haven't even started Social Security yet. So our income, we have a window of time here where we can do a lot of conversions, make a meaningful difference. One of the reasons that we target that RMD age as an important one is when you get to that point. So you turn 75, now you're subject to RMDs, or again, required minimum distributions, when you have to start taking money out of the account. You cannot convert that money. I was doing a plan yesterday with a client, and he asked, can I convert that money when I get there? And the answer is no. You have to take that money out, pay taxes. And if you don't need it, I guess you could reinvest it in a taxable brokerage account, but you can't put it back into a retirement account. You got to pull it out and you have to pay the taxes. And so when you get to RMD age, you cannot convert RMDs. You have to pull it out, pay the taxes. Presumably you're worried about this because you don't need the money to live on, which is a good thing. But it does cause issues, right? People if they don't need it, they don't like doing it. Now, if you're living off your IRA, this might not be that big of a deal, right? Because your distributions that you're living on might already satisfy that RMD requirement, right? You might not have to take any additional money out. So again, it's very dependent person to person, but that window of time between retirement and RMD start is a great window of time to start really looking at doing larger Roth conversions.
And so we can't convert the RMD itself. And I think just the D in RMD is distribution. So you're right, it's got to be distributed. But let's say someone gets to their RMD age and they still have a lot in tax deferred funds. Are they still able to incorporate a conversion strategy?
Yeah, that's a good question. And the answer is yes. You have to take the RMD first. And so that you can't convert that. That's very clear. But let's just say, we had a target of getting, I don't know, $100,000 out of the IRA to get us to the top of the 22% tax bracket. I'm just making up an example here. And our RMD was $20,000. What you could do is you could take $20,000 out that you have to take out anyways. You're required to pay the taxes. We still have room to take out $80,000 more to get us to our income target of the $100,000. Is we could then convert that $80,000. So the total amount that came out of the IRA was $100,000, which again, from a tax planning strategy, that was our target. $20,000 came out as an RMD you had to take and live off of. The $80,000 you still converted. So once you get to RMD age, it doesn't mean Roth conversions stop. It just means that you have to take the RMD first. And that is the order of things is very important. Is once you get to RMD age, the first money coming out of the retirement account has to be the RMD. You cannot convert money first and take the RMD later. So some people get the ordering wrong here. So you have to take the RMD first, then you can look at doing more Roth conversions, again, based upon the tax planning that we've done.
Hans, moving on to question number 3. Will your retirement accounts create a tax problem for your heirs?
Yes. Just kind of joking.
That's great.
It's obvious. Yes. Now, to the extent that you've done Roth conversions, no. I mean, it's not going to be a tax problem. There's still tax considerations because so what it's leading to is the second part of that question is, do your beneficiaries understand the 10-year rule? So if you have retirement accounts and you leave them to someone other than the spouse or somebody other than disabled, and you leave them to your children is really what, where they're going to end up. Your children are going to fall under the 10-year rule. And that doesn't matter whether it's traditional IRA or Roth IRA. They're going to be under the 10-year rule either way. Now, the 10-year rule for a traditional IRA, the 10-year rule period says that the account needs to be emptied by the end of the 10 years. So if you die, let's say I die in, 2 years from now, and then my wife dies at the same time, all our IRAs are going to go to our kids. And let's just say that there's 2 kids, there's $1 million, they each inherit $1 million. My kids are going to inherit $500,000 each, if that happened, of Roth IRA money. It's still going to be an inherited IRA, and they still need to understand the 10-year rule because they can leave that account in there, take nothing out of it, no distributions till the end of the 10th year, let it grow more, and then pull it all out. They have to pull it all out at the end of the 10th year, no taxes. Okay, that's still a tax problem that they need to understand the 10-year rule. But let's say all that money was in a traditional account. Okay, And so the traditional IRA, they inherit $1 million, $500,000 each, and taxes are due on that whole $500,000. Now, they're still under the same 10-year rule. So the 10-year rule says that the account needs to be emptied by the end of the 10th year. So, I have one child who's smart with money. I have another child who could probably use a little more coaching. Okay, let's just put it that way. So we have the one guy, he draws the whole $500,000 out year one. I mean, he just says, send me the money. He's going to have $500,000 added to his tax bill. Okay. And that year, so that if he and his wife make $300,000, they're going to be paying taxes on $800,000 in that year. That's pretty ugly. Okay. Now, the smarter tax planner guy, he's probably going to be smart enough to say, I better take this $500,000 and maybe take $50,000 a year. I'm oversimplifying this for 10 years because I got to have this account empty, and at first blush, he might say, let's just leave it all in there and let it be tax deferred. But then he's going to have, probably an $800,000 balance or $1 million balance at the end of 10 years. And that all gets added to his income in that year. So, just kind of gone into a little bit of inherited IRA tax planning. But just to point out is, regardless of what you do, your kids need to understand that 10-year rule. And, you do business with Cardinal and we're your planners. We get the kids involved whenever you want us to get involved. But at the very least, you have your accounts here. We're going to be here to counsel your kids. Maybe I won't be, but Drew and Tom will probably be here to counsel them at the time, because they're probably not going to listen to that now. But they will absolutely listen to them now, as you need it. Your kids are going to need advice around that 10-year rule when they inherit the money. Drew?
Yeah, great point. Moving on to question number 4, Tom. Are Roth conversions being considered at the right time? Talk about that, please.
Yeah, I mean, the timing is important, right? I mean, one of the first questions when we're doing a plan is, do Roth conversions make sense? Most plans, some level of it makes sense. Again, not all plans. Sometimes we're not recommending that, but assuming that we're recommending that. So that's the first question. But then the next question becomes when and how much. And so the whole idea of timing is wanting to get the money out at the lowest tax rates possible. I mean, all tax planning, if you really boil it down, it's paying taxes at the lowest rate possible, whether that's now or in the future. So that becomes important. One of the hard parts about that future question is we don't know what future tax rates are going to be, right? They could change, and historically they change somewhat frequently. If you really get into the reasons for that, that's one of the things that Congress can pass without needing 60 votes in the Senate. So they don't need to get a majority of the Senate to pass it. So that's one of the things that's available for whatever party is in power to do so. So do I think they'll change? Probably. I don't think they're going to go lower than they are now. So if they're going to change and they're not going lower, the only other option is they go up from here. And so timing it now when we have known low rates could make sense, as opposed to waiting for some future rates which could be higher. Now, again, all of this is within context, right? We don't want to say, okay, we're going to do that and convert all of it because we know we have the 37% now. We're going to avoid a potential 60% later. That's not what I'm saying, right? I don't think you need to just jump in and convert everything today. But certainly if your income is lower, you've retired, back to one of the earlier questions, before RMDs have started, I think it absolutely makes sense to consider converting some of that within the guidelines of a plan to try to get money out at known low rates now, as opposed to waiting for possible future higher rates.
Yeah, I think that's a great point. We as planners, we have to think about for our clients, okay, well, what might future tax rates look like? But I think we can sort of navigate in the present. We know we have historically low rates. Let's just take advantage of them now, because maybe they don't go up, or maybe they don't go up for a while, but we do know for sure that we have a very opportune window here to take advantage of that. So let's talk about it. Now, looking at question number 5, Hans, are you giving to charity in the most tax efficient way? What does that mean?
Well, the answer to that is probably not. I mean, if you're not 70 and a half, then maybe you are. But once you become 70 and a half, which most of our clients coming in are in their 60s, so this is a forward-looking thing, you have the opportunity to do a QCD, or a qualified charitable distribution, which simply means you can take money out of your IRA and give it directly to a qualified charity and not pay any taxes on it. So that is the most tax efficient way to give to charity. Because otherwise, that money, this is out of a traditional IRA, this isn't a Roth. You don't want to do a QCD out of a Roth because you've already paid tax on the money, but you do it out of the traditional IRA. That's the most tax efficient way. And you do it in a year where you have an RMD coming due, that counts toward the RMD. So that's the most tax efficient way to give to charity. And we have a lot of clients that we put this into their plan, where they have planned giving in that first year that they turn 70 and a half, and then it's every year after that. But these are only clients that are charitably inclined. It makes no sense to start giving to charity just to get a tax deduction or a tax benefit, because you end up with less money. So this is only for the people that are charitably inclined.
A couple follow-up questions for you, Hans, on this. One, is there a process to do this correctly, or can someone just try to direct the money towards the qualified organization?
Don't try this at home. So the answer to your question is yes, there's a process, and you mess up one thing, it's going to become a taxable distribution, and then the charity's going to have the money. So the answer to that is get professional help rather than do that. We have other videos where we go through QCDs and go through all those steps if you're going to do it alone. But for the purposes of this video, get help, call us, and we will show you how to do that. And if you have the account with us, we'll essentially do it for you.
And last thing before we move on to the next question, kind of similar to Tom bringing up that the RMD has to come first before you do any additional conversions. Is there a proper order to handle a qualified charitable distribution when someone's RMD age?
Yes. I mean, it's going to be the first RMD that you're going to do. So if it's only part of if it was the whole RMD, I mean, we have some clients that have relatively smaller IRAs, and let's just say they have $200,000 in there, and their RMD, they're 75 years old, and their RMD is about 4%. So they have an $8,000 RMD, and they're going to do their whole RMD, the whole 8,000, as a QCD. It's very important in the ordering that that's done as the first thing in the year before they take out any other money. Now, if we took the same client and we said, okay, they're going to do their RMD, but they're going to only give $2,000 to the charity, so they're going to do a QCD of $2,000. You're going to do that first. Then you're going to take the other $6,000, the rest of the RMD, out of the IRA. And now you got all 8,000, your RMD is taken care of. And then any other distributions you're going to make out of the thing, or Roth conversions, you're going to do after you've done those one or two things.
Thanks a lot.
Okay.
Next question, Tom. Do the 2026 tax rule changes affect you?
I want to be like Hans. Yes. I mean, of course they change. I mean, every year there's certain changes that happen every year, right? The increase, I guess maybe not every year. Most years they increase the IRA contribution limits, the 401k contribution limits change. So those are normal increases. In 2026, really in 2025 and 2026, we had some pretty big changes that came along with the Trump's signature bill, the One Big Beautiful Bill. And those do have some pretty big impacts, right? I'm thinking about this extra senior deduction that now is included, right? So if you're over 65, you have a new senior deduction up to $6,000 per person that you can claim. But there's income thresholds for that. If you earn above too much, you might lose that deduction. So now that adds another factor then that we got to consider when we start thinking about Roth conversions or other income sources that we're doing. So that's one piece. They've also included a new deduction for SALT deductions. That's the state and local tax deduction. So it used to be, or back a long time ago, there was no cap on it. When Trump's first tax law, the Tax Cut and Jobs Act, they capped it at 10,000. In the one big beautiful bill, they increased that to 40,000 as a cap. But that also has income phase out limits. So if you earn above certain income numbers, you lose some of that SALT deduction. So that's another threshold we got to keep track of. There's new thresholds around itemized deductions for charitable giving. I mean, there's a lot of things that come into play around these tax law changes over between last year and this year, on top of just the normal changes. What are the IRA contribution changes, 401k contribution changes, all of those things. So again, that's why you need to look at everything as a plan, as opposed to just focusing on the IRA itself or just the Roth conversion decision, because you might be missing other pieces there. So all of this gets mixed together. That's kind of why we have a job, right? As we sit here and we can look at all these different pieces, come up with a plan that makes the most sense for you as we take a look at everything. But at the end of the day, yes, the changes matter. You need to know about them. If you don't know about them, you might make mistakes. You might miss something you didn't know about. So that's why we would recommend you call someone like us or call us, where we can help you walk through piece by piece of what makes the most sense, really looking at the lifetime tax bill as opposed to each individual year. Right? If you focus on just a single year tax bill, Roth conversions would never make sense because you're paying more taxes now than you otherwise would have to. It's a long-term proposition. It's looking at the total tax bill on the life of this money. And certainly, once you start taking that approach to it, that's really when you can start seeing the benefits of the Roth conversion. So again, we say this on all our videos, Roth conversions, we're not, we talk a lot about them. We do a lot of planning around them. They're not for everybody. The amounts are different from person to person. There are plenty of clients that we look at this and say, hey, given the size of your balance, given the income needs you have, given what you have going on, you don't need to convert anymore. You're fine. You're good to go. You don't need to do more. More often than not, people are not doing enough. And we are saying you need to do more, a little bit more, sometimes a lot more, to take advantage of where we are from a tax standpoint.
Now, one thing I want to add to that, to our viewers here, especially ones considering calling us, we'll put numbers in front of you all day, but if you tell us, I don't want to do that, that's what we're going to move forward with. Okay, we're here to support you. We want you to be educated. We want you to feel confident in whatever decisions you make, but ultimately, it's your decisions, it's your life, it's your money. We want to support you so you feel good about whatever it is you're doing. Okay. So on to the next question here, Hans. Are IRMAA, or Medicare tax, as we can view it, thresholds limiting your Roth conversions?
The answer is, for most people, yes. I mean, because most of the people that we talk with aren't doing any Roth conversions, or they're just doing small amounts. They're just looking at the tax, seeing how much they can stand, and they're doing it on their own. They come into us for planning. Most of the time now, this is different than it was 5 years ago. People are pretty educated on IRMAA because, first of all, they might be paying it. They'd already hit them at 65, and it hit them. They had no idea that how much money they made 2 years ago is going to affect IRMAA, and so they've made themselves educated. And it's become a big stop sign. They say, man, we got to keep that income under 218,000 at all costs for a couple, and for a single under 109,000. So they do all their financial planning around IRMAA and avoiding it, which makes sense. And we support people in that. But it doesn't always make sense. All of a sudden, we're looking at Roth conversions. And so you have somebody that has $1 million IRA or a multi-million-dollar IRA, and they're staring down RMDs, in 4, 5, 6, 7 years. And they're looking at that, and we start calculating the RMD. We put growth on the account. They're going to have a huge IRMAA bill when they're 73, 74 years old. When we show them that, out of their control, because their income is just going to be up because of the RMD. So now we got their attention. It many times is going to make sense for a person in this situation to figure out how much IRMAA they can stand along with how much tax they can stand, because the long-term benefits, you do a Roth conversion, you've created a tax-free account. It's going to grow tax-free. It's going to be accessible to you when you're older and accessible to your surviving spouse. And then it's going to pass to your heirs tax-free. The tax benefits of a Roth conversion can last generations. The IRMAA tax is for 1 year. I mean, it might be 1 year every year, but in the planning considerations, it's my general feeling for people with large IRAs that standing a little bit of IRMAA is going to be far outweighed by the benefits of the Roth conversion.
Yeah, great point. Thanks for that. Last question on the board here, Tom. Are you prepared for the widow's penalty?
And I would say most clients are not, right? They have not thought that far ahead. I mean, I think this must be human nature. Most people are focused on the here and now. They're not looking forward to the future. They're not doing long-term planning. And one of the things, we did a video on this that aired last week where we spent a lot of time talking about the surviving spouse. What happens when one spouse passes away? And if I had to summarize this, things get more expensive. Taxes go up, IRMAA goes up, income typically isn't reduced by that much. And so when we start thinking about retirement and what types of accounts you're holding your money in, I want you thinking about now, but also thinking to the future, especially if you're married, what impact that has on your surviving spouse if you were the first one to pass away. Because at the end of the day, that is an important piece of it. And that oftentimes speaks to getting more money out in a controlled way, controlling for all these different pieces via Roth conversions to help prepare that surviving spouse to be in a better situation. Because any money that's left in a Roth to the surviving spouse, one, they don't have RMDs on Roth money, which is nice. Two, if they do have to take money out to live on, it's not increasing their taxes. It's not increasing their IRMAA levels. And it just doesn't really impact much of anything. And so Roth money is great money to leave to spouses. It's great money to leave to generations. Roth accounts are wonderful. The hard part is to get to the Roth account, you got to pay the taxes. And so again, that's painful for a lot of people as they get through this. They understand the whole concept. They like the idea. Then we get down to do it and we show them what the tax bill is. They say, I can't do that. I'm not doing that. And it's like, well, I mean, that's okay. I mean, we can do that, but we're we're short-sighted. Most people don't like paying taxes now when they can wait. And oftentimes that means by waiting, they're setting up for more taxes in the future. So again, back to a statement I made earlier, all tax planning, all of it is around really trying to pay taxes at the lowest tax rate possible, whether that's now or in the future. Our job is to help you figure out when that lowest rate is. Again, we have to make some assumptions. But more often than not, we're seeing people not take enough out. They're taking too little out now compared to what we think they should be doing. And again, that's all part of it, built into a larger plan.
Any final thoughts, Hans?
Yeah, I mean, just going to go over how do these 8 questions, how does tax planning fit into a comprehensive plan? And, if you have a high income in retirement, a moderately high income, you're going to pay some taxes on your Social Security. Medicare, it's IRMAA. I mean, we talked about IRMAA today, and IRMAA sometimes is voluntary, where you're going to pay more IRMAA to be able to do a Roth conversion. And we got to balance the trade-offs with that. Long-term care, I want you to be real clear, is if you're self-insured or uninsured, and you're just planning to pay for your long-term care out of your resources, understand it's going to have huge tax consequences when you're pulling a lot of money to pay for long-term care out of an IRA. You're going to have to pull out money for the taxes too, and understand that long-term care insurance pays benefits to you tax-free. We already checked the 401k IRA box. That's what this whole video has been about. Income, we've talked about that a little bit today. Estate planning is really the benefits of a Roth IRA to your heirs are wonderful. It's just they're going to inherit tax-free money. And we talked about taxes. So I want to bring Tom and Drew back on. I'm Hans Scheil,
I'm Tom Griffith.
And I'm Drew Samalo.
and we thank you very much for listening.
Thank you.
Thanks.